I think the biggest shock we've seen is just that divergence. I mean, you look at the numbers and they look good, but the truth is the average company hasn't done as well. And so I think people are nervous about this excitement that we're having this relief rally, but at the same time, they're saying, why is cooler data or weakness actually a good sign? I think we have a lot of things we have to digest right now,
Well,
for sure.
Katie, you're not only a strategist, you're also a co-portfolio manager. So I want to hear, how are you advising clients to position going into year end, and what do they buy, what do they sell going into next year?
Well, I think the biggest thing we've focused on is fixed income, and that's where we've come to this inflection point. And I think we have to figure out, are we going to get those cuts or are we going to have to wait longer for them? So I think investors have to really think about what the potential impact of opportunities for fixed income is next year. And then also consider, how does this tighter policy continue to percolate through the equity markets, and where does that create opportunities and where does that create problems for in places based on just sort of that duration exposure that might be more prolonged than we like.
So, Katie, do you think we've seen peak rates back in late October?
Oof, that is the $1 billion question, to be honest.
Well,
For me,
you're the
I'm
one who went to
asking every
MIT. You got a
day. I want to
PhD at
know.
MIT.
Tell us.
Well, you know what's interesting? Yeah, so sorry. Yeah, no. What's interesting is we're really at that inflection point, because I've been looking at the trends in fixed income, and we started off with the inverted curve. We moved to a disinversion this year. The next phase is naturally a steeper yield curve. The question is, do we have a steeper yield curve because of some difficult situation where we actually have higher rates for longer, or do we get cuts? And I think that's where I'm not sure yet, to be honest, but I do think we need to have a steep yield curve at some point.
How do you view the direction of the economy and also consumer spending? Because there's so much still kind of gloom out there about the consumer pulling back. I mean, if you look at those third quarter GDP numbers, we'll get another revision on that later this week. I mean, that was close to 5% growth. If you look at the Atlanta Fed numbers, obviously those are coming down around 2% for the fourth quarter. But just on the back of this record online sales for Black Friday, I mean, should we really be concerned about consumer spending?
Well, this has been a continual question as well, is that consumers are just being much more resilient than people have expected. And I think that's why this narrative of when do we cut rates, when are we done, has been so hard, because there hasn't been a clear sign that we're ready to cut anytime soon, because consumers continue to be resilient. And, the recent data this week has really already showed that, it's not clear.
Katie, I guess the one of the trades that we read about a lot this year was, the hedge funds short Treasuries. Do you think that's still the case, or have they kind of covered that here?
Okay, this is a great question. I love this question because I'm a quant. And when I look at the signals right now, what is alarming to me is long-term signals are still short in fixed income, given the moves that we've seen until recently. Shorter term signals are moving more on the long side. So we're seeing this sort of mixed view on fixed income. So that inflection point so I do think because of that, there are going to be some investors who still think this may not be over yet. And so I think that's mixed, but there's definitely less of them than there were before.
What about in the commodities market? What is energy telling us about the direction of the economy?
This is really one of my favorite questions, because we have really been pointing to the energy moves earlier in the fall when we started to see energy prices surging again. But look what happened recently. Energy is now a short signal, and that's been one of the more recent developments. And that tells us that we didn't really have enough legs in that energy move to cause some serious issues for inflation, which is a positive sign, I'd say, for this inflation narrative of raising rates is a little bit more likely to be over soon, which I think is good for the consumer. It's good for this getting to target. And, it's something to continue watching, but definitely it had moved to a point where we were watching it, but now it's come back and now it's short are the signals for energy. Kind of interesting.
All right, so in the Treasury market, why can't I just go buy a 2-year Treasury and get my close to 5% and just kind of call it a couple of years here?
Well, the problem is you're going to have to roll that over, right?
Yeah, but 2 years,
yeah.
a lot can happen in 2 years.
Yeah, that's true. And so I think where the challenge is that if you look at where the curve is today, we still don't have that duration premium there. So if you buy longer term debt and we do have an environment where yields continue to be higher, that might be negative NPV in relative terms. And I think that's where I think you have to think about what is going to happen for cuts is going to dictate when we get to that steeper curve or a more normal yield curve. So yeah, the 2 year looks still very good, and I think that's why people are buying it right now, and that's why yields have been going down because people think this opportunity might not last. So maybe it's time to buy treasuries because you want to lock in those rates.
We only have about 45 seconds left, but what's the top question that you hear from your clients?
Oh, I think the biggest question is, are we done? Are interest rates going to go down and when? And tell me now, because I think everybody really wants that for many reasons because we're used to lower rates. But we have been very strong this year saying higher for longer. And to be honest, most of the year we've been correct. So I would generally have been telling them to be patient and that to expect that higher rates could last longer than you like.